Hi, this is Mike Maloney with an urgent plea and warning to the members of the Federal Reserve Open Market Committee and the Federal Reserve System. If anybody knows anybody there and can get this information to them as soon as possible, I certainly would appreciate it. They're going to be making some decisions in the next couple of days that are going to have an enormous effect on the economy, and I want to put in my 2 cents worth, so to speak. The only thing that I've got to say here is that I feel for you guys. I know that you guys and gals, the Federal Reserve Open Market Committee is 50% women, 50% men right now. I really feel for you because you are in a predicament and you have to make a decision that's going to affect everybody's lives. And this is very, very precarious. We are on some thin ice at this point. First, I want to say that I'm going to define a lot of stuff going through here because I also want people viewing this video to be able to follow along, people that don't understand finance that deeply. And so I want to start with something right off of the Federal Reserve's website here. Changes in the federal funds rate, trigger a chain of events that affect other short-term interest rates, foreign exchange rates, long-term interest rates, the amount of money and credit, and ultimately a range of economic variables including employment, output, and prices of goods and services. That's from the Board of Governors of the Federal Reserve System. And so talking about that Fed funds rate, this is where we want to start because this is the basis of how the Federal Reserve influences the entire economy. There are other methods. They have a few different hammers in their toolbox. But if you take a look at this, I call this the rate roller coaster. When they lower interest rate, it stimulates the economy by spurring more lending and loans. When a bank creates a loan, they create the currency. The currency did not exist until you sign that loan. The bank creates the currency. It's a double-entry bookkeeping process. They deposit the currency into your your account at your checking account at your bank. And they do that because you're going to buy something. You're going to buy a car or a house. That's the collateral against the loan. If they think you can pay them back, they'll make the loan. If you don't pay them back, they have the collateral. So they'll make the loan. But because the loans are being made, it means that there's more transactions happening. More cars are being purchased, more houses are being purchased. It stimulates the economy, but it also creates more currency in the economy and more debt. But anyway, you can see that when they come off of low interest rates, the economy starts to heat up. And so they raise interest rates until they either cause a recession or they cause a crisis. They break something. They cause a crisis and a recession. Lately, it has been crises and recession that their raising rates causes. And this is the danger that we find ourselves in right now, and I'll show you how dangerous this is later in the video. And there are potential solutions here. So this is the rate roller coaster, but what concerns me isn't that they're raising rates, but the speed that they're raising rates. Take a look at how careful this is Alan Greenspan here raising rates in very, very small steps over a very long period of time, trying not to break something. But we had repealed Glass-Steagall, which separated banks from brokerage houses and eliminated a conflict of interest. We got rid of that so the conflict of interest could once again happen, and it did. And then also, there were all these new derivatives that were created, and the ratings houses putting false ratings on these mortgage-backed securities and other collateralized debt obligations. Greenspan lowered interest rates in response to the crash of the NASDAQ. He was trying to reflate the stock markets. He didn't even see the real estate bubble that he was creating that came out of left field. But he was very, very careful and then handed the reins over to Ben Bernanke, who continued the rate rises at the same slow, measured pace, but still, it broke the economy and caused the global financial crisis of 2008, lowered rates down to basically zero, somewhere between one day it was 0.04%. And so this is the effective funds rate. For everybody that doesn't know, there's a target rate, a upper bound and lower bound. The Fed tries to keep it, and they've done a very good job of keeping it within that range lately. You can see how choppy it is back here and how much smoother the line is later on. So they are able to control this better. But should they be doing this in the first place? Ever since the Federal Reserve opened its doors in November of 1914, their mandate is to manipulate the economy and thwart the free market. You just saw that the changes in the Fed funds rate affect long-term rates, interest rate, long-term, short-term, foreign exchange rates. It affects the price of goods and services. It affects employment. It affects the entire economy. 50% of every transaction that we make is the currency involved. 8 times a year, a bunch of men and women gather around a table in the Federal Reserve building in Washington, D.C., the Federal Open Market Committee, and decide basically what the policies are. They've got a target for how much currency is going to be in the system and what the cost of that currency is. If that 50% of every transaction is being manipulated and not being set by the free market, then you do not have a free market. So when something breaks, and it probably will, when the next big crisis comes and they scream, "Oh, the free market isn't working, we've got to do something about it," just remember, we do not have a free market. We haven't had since November of 1914. So what concerns me most is this speed, the rate of change. So let's take a look at that. I've got these recession bars on. I'm going to leave them on so you've got a reference for this next chart. But this one goes all the way back it goes back to 1954, like the other one. So we've got 68 years of data here as a reference. But look at the speed of this change. This is 4,600% higher than it was a year ago. That is something that has never happened before. And to me, this is very, very scary. Now I'm going to take away the recession bars so that you can just let this sink in a little bit, how big and how potentially scary and damaging this could be. Nothing like this has been tried. Now we're going to take a look at what the Fed funds rate affects first, short-term interest rates. This is the 3-month Treasury bill. There are bills, notes, and bonds. Bills are short-term, notes are medium-term, and bonds are long-term Treasury debt. And what concerns me here is that Treasuries, especially the shorter-term ones, they aren't just an investment or a speculation or something that somebody buys for cash flow for retirement or something like that. These act as the plumbing of the entire financial system. Banks hold these as collateral. There's something called the repurchase agreements markets, where if a bank needs cash, they pledge one of these short-term bills like this as collateral. And now we're changing the rate that these pay dramatically, very, very quickly. And the problem with that is that the price of a bond or a bill or a note is the inverse of the rate that it's paying. And so if the rate goes up, the value of the bond, note, or bill that you're holding goes down because the newer ones that are being auctioned by the Treasury pay more. And so the one that you're holding on to is worth less. And so to have all of these functioning in the background of the financial system and making up the real plumbing of the financial system and the electrical system. I mean, this is a circuit here. And these are like the electrons, and suddenly they are changing size. Now, this one, look at this, 8,200% change over a year ago. And this one goes all the way back to 1934. So now we have 88 years to compare. Nothing like this has ever happened in the history of the United States. And this has me very, very worried that something is going to break. And I'll show you exactly how horrific the consequences will be this time around. Lehman Brothers, the 2008 global financial crisis, walk in the park compared to this. So here is the effective Fed funds rate again. So they've got the target and they've got what they come out with. Now I want to take a look at inflation. So this is the Fed funds rate. This is inflation, and the scale has changed a little bit because we went through a couple of deflations here. So on the Fed's website, I generate all of these. And by the way, thank you, St. Louis Federal Reserve, for offering your research and educational division. So the FRED, the St. Louis FRED. If anybody wants to generate their own charts, take a look at the data. Marvelous resource, more than 500,000 data sets that you can generate these charts all by yourself and try to guess what is going to happen in the global economy. It is a tremendous resource. I recommend everybody check it out. But you can see here this sudden spike in inflation that has happened over just the last couple of years here. And it puts us back into territory that we haven't really seen since the early 80s and all through the mid to late 70s. And back then, I lived through some of that. I was not yet an entrepreneur. I didn't have my own business. I didn't realize what a headache it was. But I did have businesses all through this area. And I know what it's like to try and keep up with this type of inflation. You have to, people raise their prices on you, the products you're buying, to create your good or service. And so you have to raise your prices to the consumer. And just when you do, all of your employees are now not getting paid enough because they've been experiencing inflation. So you got to give them raises, meaning all the profit that you thought you were making by raising your prices is now gone. And then your suppliers raise their price again. And it's this vicious spiral that has to go up and up and up until the quantity of currency reaches an equilibrium with the quantity of goods and services out there. That's one of the things I'm going to get to in a little while. So this is inflation. You just saw the Fed funds rate. Let's put them together. So here they are overlapping. What I really find interesting here is there are these very rare moments where the inflation exceeds the federal funds rate. But most of the time, the inflation is below the federal funds rate. There's, this little sliver here. There's a little tiny sliver in there. There's this sliver right here. There's this sliver. There's this little thing right there. I call this the Greenspan goof. This is Bernanke's blunder. This is Janet's jam. She was really in a jam that Bernanke and Greenspan left her in. And this is Powell's predicament. We didn't have this much where the Fed funds rate is below the rate of inflation until this century, and especially after the global financial crisis of 2008. Right now, the Fed is talking tough, and you're trying to do so, you're trying to be a Paul Volcker. But what I want to point out is that Paul Volcker started with a very undervalued stock market. There were no bubbles. There was no bubble in real estate. There was no bubble in stocks. There was no bubble in bonds. Everything was undervalued at that period of time. And he raised rates significantly over the rate of inflation. And, this doesn't look like a big difference, but for the viewer, you have to go straight up vertical. You've got to pick a time and measure the distance here. And what I find amazing is that most of the time, the Fed funds rate was more than double the rate of inflation. A little bit over was the average, but double the rate of inflation. Sometimes it was only 50, 60, 80% above the rate of inflation. But there are some times in here where it's more than 3 times the rate of inflation. So we've got 8% inflation. Can you imagine the Fed funds rate at 16% or 24%? That's not going to happen. But that was the type of environment that Paul Volcker was able to enjoy when he was able to do this. The predicament that Powell finds himself in right now, you can't do the same thing. So this is, if we look at that spread, that difference between the federal funds rate and the rate of inflation, or vice versa, so this is that spread measured in a percent. It's not measured in how many times, what percentage over it is. It's measured in the difference between the Fed funds rate percentage and the year-over-year change in the consumer price index percentage. And so the Fed funds rate was 2.5% over the consumer price index here. So you can see those little slivers where I pointed out that it dipped below. But when Paul Volcker took the federal funds rate extremely positive, way above the rate of inflation, and it stayed there for a long time, he was able to do that simply because there were no bubbles when he was doing that. And so just remember this downslope here, where he was able to reduce this and get the economy rolling once again from the early 80s to the early to mid 90s. And then Greenspan did it again. We had the 1992, the reason it went down here is the 1992 recession, the first Gulf War and the recession. But look at what has happened this century. It has spent most of the time in this, before the crash of the NASDAQ and Greenspan's response. Before that, you have mostly positive, where the Fed funds rate is higher than the rate of inflation. But this whole century, we've had mostly a Fed funds rate that is far, far below the rate of inflation. And look at where it is today. So what has that done? This is when the Fed funds rate is low. What could have caused all of this inflation? Do you think that it could be, is it the boogeyman over in Russia? Is it the excess demand from the pent-up demand from the lockdowns and the supply chains disruptions because of the lockdowns? Or could part of it possibly be because $6.2 trillion was added to the currency supply? This is 40%. Back here in just before March of 2020, February of 2020, we were at 15.5 trillion. By February, 2 years later, we were at 21.7 trillion. That's $6.2 trillion difference. It's a 40% increase in the currency supply. Now, I will show you 5 trillion of this was the Federal Reserve directly. 1 trillion was the policies where the banks created the other trillion. But if we take a look at the percent change of the M2 currency supply, the percent change from a year ago, you can see that something is really different this time around. Is it the boogeyman in Russia? Is it Putin's folly? Is it the supply chain disruptions? Or could this have been a whole bunch of stored energy that was just waiting for Putin to light the fuse? Is this the gunpowder that you put into the bomb that Putin and the supply chain disruptions merely lit the fuse on? It's releasing the energy that had already been created. And so that is where the inflation came from. Mostly this, a little bit supply chain, instantaneous demand, and Putin. So this is that same area where Paul Volcker was able to reduce interest rates. The currency supply, we weren't creating as much currency year over year over year. And when we got here to the mid-90s, we were barely creating, the currency supply was not expanding very much. And so inflation was getting under control, not just because of interest rates, but because of the currency supply being limited in its expansion. So part of that is keeping the interest rates way up over but Greenspan also tried it right in here, and that didn't work, and it didn't work back here. So it's a combination of all of these things that can keep inflation under control. But just raising rates, slamming them up, you're going to break something. And when you break something, I'm going to show you in a minute, this time it is going to be a financial Armageddon. So this is the total assets of the Federal Reserve. So everything that the Federal Reserve owns, and they own all of this. This is where, when I said $5 trillion of it came from the Federal Reserve, of the expansion of the M2 currency supply came from the Federal Reserve, $1 trillion came from the banking sector. This is that $5 trillion right here. Now, to paraphrase John Hussman, keeping a balance sheet of this size is like keeping a nuclear bomb in the basement. Nothing good can come of it. I'm sorry. So this is the way things grew before Ben Bernanke started us down this road of quantitative easing and emergency maneuvers, and the very fact that we've had these zero interest rates for so long, so many years, and so the Fed funds rate right down at nothing, and inflation up at 2% or 1.5%, just shows that the economy never, ever recovered from the global financial crisis of 2008. We put a Band-Aid on cancer. The cancer is still growing. And so this is the Federal Reserve's balance sheet. But one of the things that concerns me, and this is directed to the St. Louis Fred, the other data sets that we were looking at, the other charts, all started in 1954, 1956, or 1960. This data set only goes back to 2003 if you want to see this up to today. And there was no reason to do this. You had a data set, and it's the same data set. It's measured in millions of dollars. You used to call it resources and assets, total resources and assets. And this was your balance sheet going back to the day you opened your doors back in 1914, November of 1914. So this is a correct accounting. And then you stop this in 2014, so like a 100-year anniversary of it, and you go to that, you go to a data set that starts in 2003, so it starts back, you're starting the new data set here and taking it out to today. It's got this big overlap. It's the exact same data set. Why would you do this other than to obfuscate something, to keep people from having this historical perspective? So I've got this great spreadsheet guru, chart maker master. He's Alan Hibbard, and I needed this chart this morning, and he was able to take the two data sets, put them together for me, and here we go from the time that you opened your doors, and then we've got QE1, 2, and 3, and then QE4, which will probably end up turning out to be QE forever. If the Fed breaks the economy, and they really risk that right now, if they break the economy, then there's this huge contraction that happens, bankruptcies, bailouts, and the Fed will just start creating currency like crazy, and this will go way off. I mean, if you think this is bad, baby, you just ain't seen nothing yet. So this goes from 1960, like all the other graphs that we looked at of inflation and Fed funds rate and everything else, and the M2 currency supply. But here, one thing we're seeing here, there is a ray of hope. There may be a solution to this. What we're seeing here is there's a contraction of the Fed's balance sheet lately. And you'll notice this is demand deposits. So this is checking accounts. This is all of the currency. I mean, we're talking about over $5 trillion going from just 300 or 400 billion before the global financial crisis in checking accounts to $5.1, $5.2 trillion sitting in checking accounts, waiting to be spent. Now, a lot of this is being spent. When somebody writes a check to somebody else, it just goes from one checking account to another. There's a couple of days of float, but other than that, there is some velocity that happens while currency is sitting in checking accounts. So now prices. We've got a certain amount of currency in the currency supply. You've got a certain amount of goods and services, and the currency supply and the goods and services need to strike an equilibrium with each other, and that equilibrium is arrived at through price. So the price of goods and services has to rise until it sucks up all of this excess currency, and it will do it whether you pop all of the bubbles and create a crash and bomb us back into the Stone Age. As we come out of that, if this currency is still around, if it doesn't vanish, and I call it currency, not money, because money doesn't vanish, money stores value, money has no counterparty risk, only fiat currencies have all of these problems. But something has to balance here eventually, and it will. So this is deposits at all commercial banks. So this includes every kind of deposit, not just checking accounts. And here we are it hit over 18 trillion, but it's rolling over and contracting. And this is a good thing because maybe prices don't have to rise quite as much. This just has to be managed until the prices come to meet that and things stabilize. And then this boogeyman of inflation will start to go away. This is the rate of change of the deposits. And what you can see here is, this big, huge blob here, plus that spike that was, probably the payroll protection scheme. And this is probably sending checks directly to the public. This is payroll protection scheme and sending checks, and then this is the other couple of rounds of it. But it isn't really, the year-over-year change is now negative, and this is a good thing. It means that we've stopped this crazy expansion of the currency supply. So there is hope. These are the bubbles that this expansion of the currency supply has pushed us into. It happened back in 1929. This is PE ratios. This data is from Dr. Robert Shiller of Yale University. And so what you see is how overpriced or underpriced the stock of companies in the S&P 500 is, according to Dr. Robert Shiller's CAPE ratio, which is a trailing PE. The times to buy stocks were down here. We have been in a crazy bubble. Fair value is actually somewhere around 12 or 15. And we've been in a crazy bubble, and we touched fair value in the crash of 2008, but they slapped a Band-Aid on cancer, and they prevented us from visiting undervalue and for a brand new healthy bull market to develop. And instead, we had all of the QE. We pushed this back into another bubble, much bigger than 1929. Second, according to this measurement, PEs, to the NASDAQ .com bubble of tech.com bubble of 2000. And we are coming down, but luckily, right now, the markets are deflating. There is the potential out there, but it's a small probability of coming in for a soft landing. But you do not want to break this economy and cause a crash, and here are some of the reasons why. This is another way of measuring whether stocks are overvalued or undervalued. Work hours to buy the S&P 500. So the average pay for a blue-collar worker or clerical worker or somebody that isn't in an executive position or highly paid, just the average worker, how many hours it takes to accumulate the amount of dollars that equal the same amount of points on the S&P if the S&P was sold in shares, and it is through ETFs. But you can see that there was an equilibrium that went on somewhere around 20 or 22 this goes back to 1860, this data. It gets less accurate when you get back in here. But throughout, after the Federal Reserve started collecting and creating data for us and other government sources where it's quite reliable, this is fairly accurate throughout here. And then in the 90s, late 90s, it went ballistic, and we went into that tech.com bubble, and then the crash, and then the real estate bubble, and the crash, and we never got back down to fair value. We just went through this craziness of all the quantitative easings, and I realize that you are handcuffed at the Federal Reserve because you've got to buy only financial assets that are guaranteed by the United States as to the principal and interest. So you've got to buy debt instruments such as U.S. Treasuries and, since the crisis of 2008, mortgage-backed securities. They're guaranteed by the government, and so. But where does the cash flow from those come? Where does the profits? A treasury comes from our future taxes. So you're buying cash flow of our future taxes, and you're typing currency into existence to do that. Now, when the banks create currency, this is a loan, and these are self-extinguishing dollars, because as you make the payments on the books, those dollars, the debt comes down with the payments, and they annihilate each other. The Federal Reserve types $1 trillion into existence, and they buy something with it outright. And there's no debt owed. There's just that balance sheet. So what is the morality of that is what I keep on asking. And what they mostly buy is your future mortgage payments and your future taxation. But look at this. This is way up at about 125%, or 125 working hours, where it used to take 2022 was fair value. Let's go to the Buffett indicator. And this is measuring the value of the stock market. In other words, the price of a company's shares times the share float, how many shares exist, of the Wilshire 5000 index. The total full market cap index is measuring the value of the stock market against the value, the size of the economy, GDP. Now, it really should never exceed 100%. The companies that make up the economy should not be more valuable than the economy. This is there's some absolute logic here that I think you really can't. So there's some people that say this is due to the markets getting more efficient over time, and I just think that's a bunch of baloney. But anyway, look at the scale of the bubble that we're in. We've gone from 100 to 200. That means the markets are 50% over. They're 100% overvalued. They need to come down by 50%, and so far they are deflating. This is a good thing. The bubbles have not burst. Let's move on to the next bubble. Here we have real estate. So this is Dr. Robert Shiller's. Oh no, this is the S&P 500, but it's the Case-Shiller National Home Price Index from the Federal Reserve. And what you see here is that this is indexed to 100 in the year 2000. And so this is a percentage above and below the index point. And what you see is that we're up, the good news here for the Federal Reserve, for the global economy, for anybody being really, really careful if they have any influence on the economy, is that this is deflating. It isn't crashing off of a cliff yet. It's deflating. The next one is the rate of change, compound annual rate of change. And what you see here is that it is no longer, all the currency that was created and pumped into the markets, and the low interest rates especially. The low interest rates cause banks to make home mortgages at lower interest rates, and that causes this boom in real estate. And now real estate is starting to roll over and go down, but it isn't a complete crash yet. Now, this is Dr. Robert Shiller's data going all the way back to 1889 or 1886. I can't quite remember. This is real home prices. So the home prices are adjusted for inflation. Now, I do think that this 100 index line should be somewhere up in here. This looks like fair value. When you get back here, data is hard to collect. You're going off of old newspaper articles and stuff like that. But Dr. Robert Shiller has done a tremendous job and an awful lot of work putting this together. I think he's done some great work here. But look at what has happened. Now, this data is several months old, so it isn't showing the rollover yet. It's showing where it peaked, because this data, I believe, ends in June of this year. But this is rolling over. But look at how far down it's got to come. This is at 100, just under 125% above the 100 line. So it's at 225, and so it's got to crash. It's got to come down. It's got to deflate by more than 50%. If it crashes, it will probably be a financial Armageddon and take us down below that 100%, the fair value area, into an area. Now, I don't have the mortgage average income ratio and the other ratios that would be confirming this. I wish I did. This presentation was put together through the weekend and this morning. So that's all I've got on that. But now I want to show you the real danger here. This is the number of zombie companies. Now, Alan Greenspan, when he broke the NASDAQ and we had that crash, he was putting out a small brush fire. Ben Bernanke, with the crash in 2008, was putting out a house fire. There was a house on fire. This is the reason, one of the reasons. You saw the scale of the bubbles. If the Federal Reserve breaks the economy this time, they are going to be trying to put out the fire from inside the living room. They will be in the house trying to put this fire out in every direction. When the NASDAQ bubble popped and the economy crashed, what's going on here? This is zombie companies. These are companies that can't afford to pay the interest on their debt, just the interest on their debt out of current cash flow. Back before, we were down at around 3%, 3.5% before the NASDAQ crashed. And when this rises, it isn't because the companies are going out and taking on new debt. It's because the economy gets lousy and their profits shrink. So there's more and more of them. There are companies that are just below becoming a zombie company. And as soon as they can't afford to take on debt, they become a zombie company. As soon as their profits shrink, or if interest rates go up, either one can cause more zombie companies. So we went up to over 9% in 2004. Now, before I finish this, I have to make a disclosure here. This is off of two sets of data. My sources are Bloomberg with the Russell 3000 after 2017, I think, or 15, I can't remember, and Bianco Research from 2000 up to 2018. So there was an overlap, and I actually hand sketched this. I kept on printing and having my these charts scaled so that the time scale and the percent scales lined up, and I could tape these two things together on a light table and be able to trace this and put paper over it. And then I had my graphic artist create the background graph with the scales on the side that was scaled, and I went through this many dozens of iterations. And then once I got it to exactly lay over and have the scales go from 2% to 24% and exactly line up with the two other sets of data that overlapped, and the time scale to be the same increments going across the bottom, then I actually hand traced this, smoothed out some of the wrinkles, but it changes from quarterly data up to, I think, 2017 or 2018 to annual data here. The Bloomberg data that goes 2015, I think, to 2022 is annual data. The Bianco research was quarterly data. And so I did my best. There is a possibility that because I smoothed this and stuff and tried to make it easier to read, there is a possibility that it's off by 1% or 2% or possibly somewhere in this data set, 3%. But that doesn't matter. What matters here is the trend. Look at the trend. I know that the last data point that Bloomberg had for the Russell 3000, so this is 3,000 companies, there was just over 20% of all of the companies in America in this Russell 3000 index that couldn't make their interest payments out of current cash flow. And that is bad. That is 1 in every 5 companies that is hanging on by a thread. They are they're trying to survive. They're making payments, but they've got to do things like finance their accounts receivable, sell off a building, sell assets, and that affects their balance sheet badly. Now, if interest rates go up, all of these companies owe debt, and the debt rolls over. And as they have to refinance at higher interest rates, more and more companies become zombie companies, or the economy gets worse and GDP contracts, and more of these companies become zombie companies because their profits shrink. And so what you have here is the potential of this going up to like 33%, a third, 1 out of every 3 companies in the United States that you, Jerome Powell, and the Federal Open Market Committee and the Federal Reserve, all of these people will be needing to make decisions on how to bail out a third of all of the companies in the United States. If these companies close or go bankrupt, you have the possibility of disrupting already fragile supply chains. And when something collapses, then that causes inflation because of the scarcity of the product. You've already got a war in Eastern Europe with the Russian boogeyman, and you've got the Putin predicament that you're in. You've got this is the Powell's predicament right now, is how to get out of this. In the next video, I will discuss some of the ways, but one of the things that I think that the Fed is and the whole economy is just going to have to put up with. Please do not target 2% inflation. 5% to 10%. Keep it under 10%. I've lived through this before. Yeah, you have to raise your prices. You have to send out new price sheets to everybody. You've got to give employees raises constantly. You have to try and keep ahead of all of your suppliers raising their prices on you. It's this vicious upward spiral, but that upward spiral will stop once an equilibrium is struck between the currency supply and the goods and services that are available. Allow the goods and services to become more available by not breaking the economy. We've already had a lot of companies in these supply chains go bankrupt, so there's fewer companies to make these things. If you break a critical supply chain, and suddenly there's one thing that we actually need where all the companies, or any company that could supply the quantity that the world needs, is gone, and all you have are these minor suppliers or no suppliers. If that is a critical component, that cascades down into everything, and we could find ourselves in a modern dark age because of this. Now, when businesses go under And when people lose their livelihoods and lose their homes, this triggers things like suicides, divorces. You have the potential here to either not ruin people's lives or to not really care and go ahead and ruin them anyway. So please do not make this a train wreck. Do not make the economy a train wreck of epic proportions. We have a bell curve of probabilities, but out here on one of the tails, the tail risk is a modern dark age. It is actually a potential with what Putin is doing, with the war, with the problems that Europe is having with energy, the whole supply chains around the world, and then raising rates way too fast. Please, Open Market Committee, Federal Reserve, don't raise rates on Thursday. This is coming out Monday. You're meeting Tuesday and Wednesday, and you're planning on raising rates. Step back. Take a look at the results. The stock markets are deflating. Real estate is deflating. Don't crash them. The bond market has ended a almost 40-year bull market. From 1982 until today, the bond market is actually in a bubble as well. 2000 was a stock market crash. 2007 was stocks and real estate. This time, it's going to be stocks, real estate, and bonds. And if you do this, if you break the economy and break supply chains, it's all over with. We'll discuss more potential solutions in the next video. Until then, for everybody out there, I know this was a scary video. There are potential solutions. It's possible. We'll look at some history. There's the possibility of a soft landing, although the possibility is remote. I want to thank you for watching. We'll see you next time. And please pass this on to somebody at the Federal Reserve. Thank you.